Today, we've got a compelling deep dive into one of the most intriguing players in the Canadian financial arena, the Power Corporation of Canada. Are they a great investment, and just what is that connection to Wealthsimple? Fasten your seatbelts, folks, this is going to be a good one. Power Corporation of Canada, also known as simply Power Corp, had humble beginnings in Montreal back in 1925. From an initial focus on utility services, this company has evolved over nearly a century into a diversified international management and holding company. Power Corp has grown, diversified, and spread its influence across numerous sectors. From financial services to renewable energy, this giant has a finger in virtually every pie, truly embodying the spirit of a diversified multinational. Among Power Corp's many strategic moves, their involvement with, of course, Wealthsimple has been a game changer. Wealthsimple is a revolutionary fintech platform, and it's been causing quite a stir in the financial world, and of course, Power Corp has been fueling this exciting venture ever since 2015. In fact, Power Corp holds a 42.5% stake in Wealthsimple through, of course, their holdings in Power Financial, IGM Financial, and Portag 3. Join the conversation. Let us know in the comments if you currently hold any Power Corporation of Canada stock. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. In just a moment, we will be deep diving into Power Corp's fundamentals. Before we do, though, it goes without saying there are a few reasons to throw this company on your radar that we may not see fully in the fundamentals. First, and we've already hit on this, their investment footprint spans across several sectors, making it a somewhat of a one-shop stop for broad market exposure. Investing in Power Corp could be akin to buying a slice of the Canadian economy. That alone is more diversification than you normally get from a single company stock. Additionally, stability and resilience have been the hallmarks of Power Corp. This company, with its long history, has weathered countless economic cycles. Their proven resilience during economic downturns is a testament to their strong business model and, of course, their strategic foresight. With their innovative investments like Wealthsimple, Power Corp shows its commitment to staying relevant and competitive. Their keen eye for future trends and technological evolution positions them favorably for, well, long-term growth. This sounds great, and I can tell you that I am impressed so far with Power Corp. However, we do have to get down to some numbers, and for that, we will turn to our good old buddy, Mr. Math. Let's start with some surface data. Their market cap comes in at $23.46 billion, and they have a pretty stable beta of 1.06, meaning they're no more volatile than the market average. Their earnings per share come in at 2.00, and they have a price to earnings ratio of 17.59. Yeah, that does sound a little high, and when you look at the average amongst their peers, that average comes in at 10.6. So from that number there, you might think they're overvalued, but let's continue here and find out. Their price to book ratio, that comes in at 1.10. The average in those same peers is 1.40. These two numbers are saying completely the opposite. So that's very interesting. I think once we get to our fair model, we'll get an answer on whether or not these guys are overvalued or undervalued. Let's take a look at their cash. When it comes to revenue, they have $54.10 billion, and of that revenue, their earnings comes in at $1.36 billion. In fact, those earnings are projected to grow by 11.67% per year. That's not too shabby. With their free cash flow, we have $4.10 billion. That's also not bad. Their return on equity is a little bit lower than I would like. It comes in at 6.53%, but so far, I'm okay with what I'm seeing. Of course, I really want to see that fair value, so let's take a look at that. Their current value right now is $35.27. If we use a discounted cash flow model, we get a fair value of $44.16. So that means they are undervalued by 20.1%. Looks like the price to book ratio is more accurate than the price to earnings ratio. Okay, let's switch over to their dividends and their returns. So they have a dividend yield of 5.954%. That is paid out quarterly in the amount of 52.5 cents per share. Now, their payout ratio is high. It comes in at 97.00%. Of course, when we see a number like 97%, we have to ask ourselves, is that a sustainable dividend? I think in this case, we need to look at their debt before we can even answer that question. So right now, I'm going to say maybe it's sustainable, maybe it's not. We're going to get more data here here in just a moment. So let's look at their returns and see if we can figure out a bit more of what's going on. When it comes to their 3-year, their price rose from $25.82 to $35.16. That is a return on investment of 36.17%. We factor in those dividends, we get a total return of 58.20%. That overperforms the market, so it's not too shabby. When we look at their 1-year, the price actually did drop a little bit. It went from $37, dropped down to $35.16. That's a return on investment of negative 4.97%. Add in the dividends, we do get a positive for the total return of 0.46%. Once again, this is still overperforming the market while it was in a bear market, so that's not that bad as it looks. Now, when we switch over to 2023, the price has now risen again from $32.07 to $35.16. That is a return on investment of 9.64%. Add in those dividends, we get a total return of 11.27%. That is not too bad. Let's jump over to debt, because I think this is going to be where we get our true picture. When we look at their debt, their total debt comes in at $20.17 billion. Their total equity, though, it comes in at $40.94 billion. So that gives us a debt to equity ratio of 49.3%. That is pretty decent, to be honest. I want to also look at this point at their cash and equivalents. So for cash and equivalents, they have $170.16 billion. Holy banana bread, that is kind of impressive. That's a number that makes those dividends sustainable, folks. So they do have a lot of cash. All right, let's take a quick look at their short term. Short term, they have assets of $190.04 billion compared to their liabilities of $2.01 billion. I like that. Long term, not as crazy about it. We've got in assets $534.80 billion and liabilities of $681.88 billion. So that's a lot of liabilities in the long term. All right, looking at this debt situation, one thing that's interesting is PowerCore has much more cash than it has total debt, and that is great. One thing I'm a little concerned about is that PowerCore's debt to equity ratio has increased from 45.6 to 49.3 over the past 5 years. Mind you, it's not a big increase, but still it's not moving in the direction I would like to see. In terms of their debt coverage, their debt is well covered by their operating cash flow, and that's great. The interest on that debt, those interest payments are easily well covered by their earnings before interest and tax, or EBIT. So what is the final verdict? I do like this company and the diversification of their holdings. It is also kind of cool just how entangled they are with Wealthsimple, as that is a broker that has significantly changed the rules for DIY, do-it-yourself investing by providing us with, well, the options that we want. Going back to the fundamentals, PowerCore has a lot of cash, and honestly, that can be everything when it comes to long-term success. They have the money to weather a lot more than we have already seen in the economic downturn of the bear market. When the market recovers and we move into bullish territory, this is a company that will no doubt do fairly well. Their dividend has been very stable, and even with a higher payout ratio, I do believe they can sustain it. Short term, I do expect good dividends for the passive income investor and a wee bit of growth as well. When we look at the mid to longer terms, we have a potential solid total return stock. This is a fantastic company that provides a solid foundation for your portfolio, and I would even go far enough to call them a blue chipper. Of course, if you like the sound of PowerCore, be sure to do your due diligence, and hopefully if you like what you see, you may have a nice reliable addition to your stock family. Keep the learning going. Watch my video on Calgary investments linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner. See you in the next video.